Today, we're going to learn the top 3 financial ratios every business owner, investor, and finance student should know. These ratios help you understand a company's financial health, how much risk it is taking, and how efficiently it is generating profit. Let's start with the current ratio. This ratio measures a company's ability to pay its short-term obligations using its short-term assets. Think of it like checking if you have enough money in your wallet to cover this month's bills.
The formula is current assets divided by current liabilities.
For example, let's say a company has $200,000 in current assets and $100,000 in current liabilities. That gives us a current ratio of 2.0. This usually means the company has more than enough short-term assets to cover its short-term liabilities. But remember, if the current ratio is too high, it could also mean the company is not using its assets efficiently. Next, let's look at the debt-to-equity ratio. This ratio tells us how much a company relies on borrowed money compared to its own money. The formula is total liabilities divided by shareholders' equity. Suppose a company has $500,000 in liabilities and $250,000 in equity. The debt-to-equity ratio is 2.0. That means the company is using $2 of debt for every $1 of equity. A high debt-to-equity ratio can mean higher financial risk, especially during economic downturns. However, in some industries like utilities or telecom, higher debt levels are normal. So the best way to use this ratio is to compare companies within the same industry. Now let's move to one of the most important profitability ratios, return on equity, or ROE. This ratio shows how efficiently a company is using shareholders' money to generate profit. The formula is net income divided by shareholders' equity. For example, if a company earns $100,000 in profit and has $500,000 in equity, its return on equity is 20%. That means the company generated 20 cents of profit for every dollar invested by shareholders. Investors usually like a higher ROE because it suggests the company is using its capital efficiently. But always look deeper to understand how those returns are being generated. Let's quickly recap. The current ratio measures short-term financial health. The debt-to-equity ratio helps you understand capital structure and risk.